Hello and welcome to Wall Street Signal, your trusted source for the latest insights from the U.S. financial markets. As we wrap up another eventful week on Wall Street, investors are digesting a combination of strong corporate earnings, shifting economic data, and new signals from the Federal Reserve. The market's story this week has been one of cautious optimism, gains across major indexes, tempered by lingering inflation concerns and ongoing global uncertainty. Today, we'll take you through the highlights of this week's performance, what fueled the rally, what risks remain, and what to watch as we move into the new trading week. This week, U.S. stocks continued to climb, extending a multi-week rally that has pushed the major averages near or above record levels. The S&P 500 gained roughly 1.5%, closing just shy of its all-time high. The Dow Jones Industrial Average advanced more than 2%, marking one of its strongest weekly performances of the quarter. And the Nasdaq Composite, despite some midweek turbulence in tech stocks, managed to end the week with solid gains. Behind the rally, renewed optimism about corporate earnings and hopes that the Federal Reserve could be nearing the end of its tightening cycle. Investor sentiment has been improving, and market breadth, a key indicator of overall participation, showed encouraging signs of expansion, meaning gains weren't confined to just a handful of large-cap names. However, the story isn't entirely smooth. Some analysts warn that the market's recent strength may be running ahead of fundamentals, with valuations once again approaching levels that could be hard to justify if growth cools or inflation re-accelerates. Still, for now, the trend remains positive. Investors continue to favor equities over bonds, as Treasury yields have steadied after several volatile weeks. Inflation and monetary policy once again dominated headlines this week. The latest Consumer Price Index (CPI) report showed that prices rose slightly less than expected in September, a relief for markets worried about renewed inflationary pressure. Core inflation, which strips out food and energy, remains stable, a signal that price pressures are cooling, though not completely gone. This data, coupled with signs of slowing wage growth and softening consumer spending, has given the Federal Reserve some breathing room. Market expectations have shifted. Traders now see an increasing likelihood that the Fed will hold rates steady at its next meeting and possibly begin discussing rate cuts in the first half of next year. Fed Chair Jerome Powell reiterated the central bank's dual mission, maintaining price stability while supporting employment. In remarks this week, Powell acknowledged the progress made on inflation, but stressed that the Fed remains data-dependent. That means each new economic report, whether on jobs, inflation, or consumer activity, could influence the path ahead. The bond market responded accordingly. The 10-year U.S. Treasury yield fluctuated around 4.3%, a modest decline from last week's highs. Lower yields typically boost growth-oriented sectors like technology and real estate, both of which saw renewed investor interest. Meanwhile, consumer confidence dipped slightly, reflecting mixed views on economic conditions and inflation expectations. Retail sales, however, surprised to the upside, suggesting that spending remains resilient despite high prices. Altogether, the economic data painted a picture of an economy that's cooling but not collapsing, a soft landing scenario that continues to underpin equity optimism. Let's turn now to the corporate and sector landscape. Technology remained at the center of attention as investors looked ahead to major earnings reports from the big tech giants, including Apple, Microsoft, and Alphabet. The sector continues to drive much of the market's momentum, fueled by optimism around artificial intelligence, cloud computing, and steady revenue growth. Chipmakers like NVIDIA and AMD gained ground after analysts raised estimates on strong AI-related demand. Financials also had a strong week. Big banks like JP Chase, Goldman Sachs, and Bank of America posted better-than-expected results, benefiting from solid trading revenue and healthy consumer credit activity. The financial sector has been a stabilizing force for the market lately, especially as bond yields have steadied. Energy stocks rose modestly after oil prices bounced higher midweek. Crude oil briefly touched the $85 per barrel level before easing back, driven by shifting supply expectations and geopolitical headlines. Energy investors are watching developments in the Middle East and production levels from OPEC+ members closely. Industrials also participated in the rally, supported by renewed optimism around infrastructure spending and manufacturing growth. Companies tied to construction, transportation, and defense all posted gains. Meanwhile, consumer discretionary and small-cap stocks lagged slightly, as concerns about household debt and slowing wage growth weighed on sentiment in more cyclical areas. The broader takeaway: leadership is still somewhat narrow. Tech and financials are doing the heavy lifting, but other sectors are beginning to show signs of participation, which is healthy for the overall market outlook. Globally, markets were mixed this week. European equities moved higher, helped by softer inflation readings in the Eurozone and improving business sentiment in Germany. In Asia, however, the picture was more complicated. Chinese markets saw limited progress amid ongoing property sector concerns and uneven economic data. That said, trade relations between the US and China remain an important undercurrent for global sentiment. This week saw renewed discussions between trade representatives, raising hopes of gradual improvement in bilateral ties. Any sign of progress on tariffs or export controls could provide a meaningful boost to global supply chains and multinational earnings. Elsewhere, geopolitical tensions, particularly in the Middle East, kept investors cautious. Oil and gold prices both fluctuated as headlines evolved, reminding markets that geopolitical risk remains a key variable. While not derailing the broader rally, such developments underscore the need for vigilance in global asset allocation. Currency markets were relatively stable. The US dollar index eased slightly, while the euro and yen posted modest gains. A softer dollar often supports multinational companies, as it makes their overseas earnings more valuable when converted back to US currency. Investor sentiment remains cautiously optimistic. According to the latest AAII Investor Survey, bullish sentiment rose to its highest level in over a month, reflecting growing confidence in the market's direction. However, analysts caution that optimism can become a double-edged sword, particularly when markets trade near record highs. From a technical perspective, the S&P 500 has successfully held above key support levels, and momentum indicators remain favorable. The next resistance zone sits near the 6,700 level, a psychological threshold that could attract short-term profit-taking if reached quickly. Volatility, measured by the VIX index, stayed relatively muted this week, hovering near 14. That suggests complacency could be creeping back into markets, something that often precedes short-term pullbacks. Still, volume patterns show solid institutional participation, a positive signal that large investors are supporting the current uptrend. Market breadth, the number of advancing versus declining stocks, has improved modestly, adding credibility to the rally's strength. So, what's next? The upcoming week will feature several key catalysts that could shape market direction. First, we'll get fresh inflation and labor data, including the Producer Price Index and new jobless claims. These will help confirm whether inflation's cooling trend continues. Second, corporate earnings season shifts into high gear, with reports from major tech, energy, and industrial firms. These results will not only influence individual stocks, but also provide a read on broader economic conditions. Third, Federal Reserve commentary will remain in focus. Any hint of dovishness or even patience could reinforce expectations of rate cuts in 2025. Conversely, a hawkish tone could briefly unsettle markets, especially in rate-sensitive sectors. Finally, investors will continue to watch global developments, from US-China trade headlines to energy prices and geopolitical events, all of which can ripple quickly through financial markets. To sum it all up, the US stock market heads into the new week with solid momentum, constructive fundamentals, and a cautiously optimistic tone. Inflation is cooling, earnings are holding up, and the Fed appears closer to a pause, all of which create a supportive backdrop for equities. But this is not a time for complacency. Risks remain, from inflation surprises to geopolitical shocks, and investors should stay flexible, diversified, and attentive to new data. That's all for this week's Wall Street Signal Market Recap. If you found this analysis helpful, be sure to like, subscribe, and turn on notifications so you don't miss our next update. We'll be back early Monday morning with the market preview, covering what's moving futures, P earnings, and the top stories shaping the week ahead. Thanks for tuning in, and have a successful week of trading ahead.